Who's ready, baby? Who's ready? There we go. Here we go. Let's go, let's go, let's go. We got 2 minutes. 1 minute. Let's see, let's see. See what happens. Is he is he gonna tank the market this time? Uh, and we're back, absolutely. Um, all right, here we go. Corey, that's funny. All right, we're waiting for CNBC television. We're waiting. Let's go, let's go. Shit. GameStop's pulling back, guys. Wonder, is the GameStop Congress still going? The hearing? Does anyone know? I wonder what they're talking about. It's dumping. Oh, it's pulling back. Um, no, I wonder if they said something in the congressional hearing. Is it still on? It's on, right? What are they talking about? Why is it dumping like this? Yeah, I think things are selling off because of Powell. Honestly, I think Powell's a huge influence in the market. This happened last time. NQ went up and then it dumped right after. All right, here we go.
Realm of healthcare providers and experts, and we are grateful to them and to all the essential workers for their service and sacrifice. The danger to the U.S. economy was also clear. Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. Here at the Federal Reserve, we rapidly deployed our full range of tools to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. We are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. The economic fallout has been real and widespread, but with the benefit of perspective, we can say that some of the very worst economic outcomes have been avoided by swift and forceful action from Congress, from across government, and in cities and towns across the country. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved as a result of these swift and forceful policy actions. And while we welcome these positive developments, no one should be complacent. At the Fed, we will continue to provide the economy the support that it needs for as long as it takes. Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due importantly to unprecedented fiscal and monetary policy actions, which have provided essential support to households, businesses, and communities. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up notably since our December summary of economic projections. In commenting on the stronger outlook, participants noted progress on vaccinations as well as recent fiscal policy. As with overall economic activity, conditions in the labor market have turned up recently. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about two-thirds of the jobs that were lost in December and January. Nonetheless, employment in this sector is more than 3 million below its level at the onset of the pandemic. For the economy as a whole, employment is 9.5 million below its pre-pandemic level. The unemployment rate remains elevated at 6.2% in February. This figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 4.5% at the end of this year and moves down to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Overall inflation remains below our 2% longer-run objective. Over the next few months, 12-month measures of inflation will move up as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation. The median inflation projection of FOMC participants is 2.4% this year and declines to 2% next year before moving back up by the end of 2023. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2%, as seems likely to occur this year, would not meet this standard. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Our forward guidance for the federal funds rate, along with our balance sheet guidance, will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and ties the path of the federal funds rate and the balance sheet to progress toward reaching our employment and inflation goals. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
Here's where it gets interesting.
Howard from Reuters.
Hi, Chair Powell, and thanks for that. So could you talk us through how the forecasts for 2021 map into the substantial further progress definition? 2.4% inflation, I understand that's considered transitory. That still seems like some progress there. 4.5% unemployment. Is it time to start talking about tapering yet?
Not yet. As you pointed out, we've said that we would continue asset purchases at this pace until we see substantial further progress, and that's actual progress, not forecast progress. And that's a difference from our past approach. And what we mean by that is pretty straightforward. It is we'll want to see that the labor markets have moved, labor market conditions have moved, have made substantial progress toward maximum employment, and inflation has made substantial progress toward the 2% goal. That's what we're going to want to see. Now, that obviously includes an element of judgment. And when we see, we'll be carefully looking ahead. We also understand that we will want to provide as much advance notice of any potential taper as possible. So when we see that we're on track, when we see actual data coming in that suggests that we're on track to perhaps achieve substantial further progress, then we'll say so. And we'll say so well in advance of any decision to actually taper.
If I could follow up on that, the shift in the dots, why wouldn't that suggest a weakening of the commitment here? An awful lot of people shifted into 2022, it seems.
I don't see that at all. We have a range of perspectives on the committee. I welcome that, and we debate things, we discuss things, and we always come together around a solution. But the strong bulk of the committee is not showing a rate increase during this forecast period. And as data improve, as the outlook improves very significantly since the December meeting, you would expect forecasts to move up. It's probably not a surprise that some people would bring in their estimate of the appropriate time for liftoff. Nonetheless, the bulk of the committee, the largest part by far of the committee, doesn't show a rate increase during this period. And again, part of that is wanting to see actual data rather than just a forecast at this point. We do expect that we'll begin to make faster progress on both spending, labor markets and inflation as the year goes on because of the progress with the vaccines, because of the fiscal support that we're getting. We expect that to happen, but we'll have to see it first.
Great, thank you. Victoria.
Hi, Chair Powell. I wanted to ask about the supplementary leverage ratio. There's been a lot of talk about what you all are going to do this month, which I'm happy to hear an update if you have one. But just sort of more broadly, do you think long term that the leverage ratio poses problems for implementing monetary policy at a time when the reserve supply is going to remain large? And if so, do you think that changes to the leverage ratio, including the SLR, are the way to deal with that problem?
Victoria, we'll have something to announce on that in coming days, and I'm not going to expound upon your questions. Why don't you ask another question if you'd like to, because that one I'm just going to say that we're something in coming days.
Sure. Okay. Well, then I'll ask about unemployment. There's the unemployment rate is you all have projections for the U6 rate, but you've also been, really emphasizing the fact that that's not the only thing that you all are looking at. You're also looking at labor force participation and things like that. So are you all looking at ways of maybe adding to how you're projecting the unemployment rate to the summary of economic projections?
Well, let me say, as we say in our statement on longer run goals and monetary policy strategy, we look to a range of indicators on labor market. We never only looked at the unemployment rate, which is the only indicator of labor market outcomes that's in the SEP. We look at a very broad range. You hear us talk all the time about participation, about employment to population, which is the combination of the two, about different measures of unemployment. So it's wages, it's the job flows, it's all of those things they go into an assessment, disparities of various groups. All that goes into an assessment of maximum employment. The trying to incorporate all of that into the summary of economic projections would not be practical. Obviously the thing that we do include is just the unemployment rate, and that's a very insufficient statistic. So it doesn't include a lot of other things that we do look at. And I wouldn't want to say that we're looking to include the other dozen things that we look at into the SEP, but from time to time we do look at adding different things. But I would just say the SEP it's a summary. It's one device. It's not going to include all of the things that we look at. I think the things that we look at. We talk about them all the time. So we're not actually looking actively at significantly broadening those indicators in the SEP right now.
Thank you. Chris Rugaber, Associated Press.
Thank you. Chair Powell, I wanted to ask about the forecast overall. You're forecasting a very low unemployment rate next year, and in 2023, you have inflation, or the Fed overall is in the SE% by 2023. Yet no rate hike in any of this forecast horizon. So is this telling us that you see a higher inflation rate than what's projected, or do you not? As you've been talking about, is the unemployment rate insufficient, or what is this telling us about the Fed's reaction function? That it seems you're meeting the Fed's dual mandate by 2023, yet again, no rate hike expected.
So I guess the first thing to say is that the SEP is not a committee forecast. It's not something we sit around and debate and discuss and approve and say this represents our reaction function as a committee. It's a compilation of reaction function as a committee. It's a compilation of projections from different people, and but since we don't debate it or discuss it, it would be hard for me to say exactly why each participant did what they were going to do. So all I would say about this is that we've laid out what I think is very clear guidance on liftoff. And it's really three things: labor market conditions that are consistent with our estimates of maximum employment, And as I mentioned, we consider a wide range of indicators in assessing labor market conditions, not just the unemployment rate, inflation that has reached 2% and not just on a transitory basis, and inflation that's on track to run moderately above 2% for some time. The first two of those three are very much data-based. The third does have a little bit of an element of expectations in it. So we are very much determined to implement this guidance in a robust way. It is the guidance that we chose carefully to implement our new framework. And to meet these standards, we'll need to see data, as I mentioned. So what does this SEP really say? It says that we're committed to our framework and to the guidance we've provided to implement that framework. We will wait until the requirements set forth in that guidance are clearly met before considering a change in our policy rate. And the last thing I'll say is this. The state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future. So that's how I would think about the SEP.
Thank you. Paul Kiernan.
Thank you, Chairman Powell. My question is twofold. One, how high are you comfortable letting inflation rise? There is some ambiguity in your new target, as you mentioned, expectations driven. And do you think that ambiguity might cause markets to price in a lower tolerance for inflation than the Fed actually has, thereby causing financial conditions to tighten prematurely? Is that a concern? Thanks.
So we've said we'd like to see inflation run moderately above 2% for some time. And we've resisted, basically, generally, the temptation to try to quantify that. Part of that just is talking about inflation is one thing. Actually having inflation run above 2% is the real thing. So over the years, we've talked about 2% inflation as a goal, but we haven't achieved it. So I would say we'd like to, perform. That's what we'd really like to do, is to get inflation moderately above 2%. I don't want to be too specific about what that means because I think it's hard to do that. And we haven't done it yet. When we're actually above 2%, we can do that. Look, I would say this. The fundamental change in our framework is that we're not going to act preemptively based on forecasts for the most part. And we're going to wait to see actual data. And I think it will take people time to adjust to that and to adjust to that new practice. And the only way we can really build the credibility of that is by doing it. So that's how I would think about that.
Thank you. Matthew Boesler.
Hi, Chair Powell. This is Matthew Boesler with Bloomberg News. So there's a widespread presumption at this point that the U.S. will reach herd immunity sometime this year. And all along, you've said that the path of the economy is going to be determined by the course of the virus. I'm curious, based on the projections that you released today that show unemployment will still be above estimates of maximum employment through the end of next year and perhaps sometime into 2023, do you think policymakers need to be doing more here to sort of align the herd immunity and full employment timelines, if you will? Thank you.
So on herd immunity, I'm really going to leave that question to the experts. We don't control that. We're not responsible for defining it. And we'll leave that whole discussion to the experts. I mean, what we're focused on is the part that we control, which is the support that we provide to the economy. And there we provided very clear guidance. And in the case of asset purchases, it's at their current level until we make substantial further progress. There is an element of judgment in that, and we'll supply clear communication well in advance of actually tapering. And we just went through the criteria for raising interest rates. They're very specific, and we're very much committed to having them fulfilled robustly. I would agree with you that the path of the virus continues to be very important. We have these new strains which can be quite virulent. and we're not actually done yet. And we're clearly on a good path with cases coming down, as I mentioned, but we're not done. And I'd hate to see us take our eye off the ball before we actually finish the job. So that's how I would look at that.
If I could just briefly follow up, how do you see sort of the disconnect in terms of an economy that is expected to be widely reopened this year, but full employment taking longer to achieve? Is it the case that factors related to the virus will still be with us over the coming years? Is that how to interpret the forecast?
I think there's some of that. Sure, there'll be some of that. There'll still be some social distancing. People may be, for example, going into spaces that involve close contact with others. Some people will do that right away. Others will hold back, and so I think there'll be some of that. In addition, though, remember there are 10 million people, in the range of 10 million people, who need to get back to work, and it's going to take some time for that to happen. It can happen maybe more quickly than it has in the past, because it involves the reopening of a sector of the economy as opposed to stimulating aggregate demand and waiting for that to produce job demand for workers. This could be a different sort of a process, and it could be quicker. We don't know that. But it's just a lot of people who need to get back to work, and it's not going to happen overnight. It's going to take some time, no matter how well the economy performs. Unemployment will take quite a time to go down, and so will participation. So that's all I can say. I think the faster the better. We'd love to see it come sooner rather than later. We'd welcome nothing more than that. But realistically, given the numbers, it's going to take some time.
Thank you. Steve Leisman.
Mr. Chairman, thank you. I wonder if you could, kind of a three-parter here, but all related. Would you comment on the current level of the 10-year yield and some other long rates out there, whether or not you think they would have a negative effect on the economy? And if not, is there a level that would give you concern? And finally, the third part, other central bankers have expressed concern about what's happened to yields in their countries, and even some taken action, but not you. Could you give us your general idea or orientation towards the idea of coming into the market and affecting a particular tenor of the bond market? Do you like that idea? Do you not like it? Is it at the top of your toolbox, or is it something that you think is at the bottom of the toolbox?
Sure. So we monitor a broad range of financial conditions, and we're always attentive to market developments, of course. We're still a long way from our goals, and it's important that financial conditions do remain accommodative to support the achievement of those goals. And if you look at various indexes of financial conditions, what you'll see is that they generally do show financial conditions overall to be highly accommodative, and that is appropriate. So that's how we look at it. I would add, as I've said, I would be concerned by disorderly conditions in markets or by a persistent tightening of financial conditions that threaten the achievement of our goals. We think the stance of monetary policy remains appropriate. Our guidance on the federal funds rate and on asset purchases is providing strong support for the economy, and we're committed to maintaining that patiently accommodative stance until the job is well and truly done.
Could you give us an idea of how you sort of feel about that tool of being able to come into a particular part of the market and either doing an operation twist or something like that? Is that something you feel to be the top of your toolbox, or something that you don't really prefer?
The tools we have are the tools we have. What I'm telling you is that the stance of monetary policy we have today, we believe, is appropriate. We think that our asset purchases in their current form, which is to say, across the curve, $80 billion in treasuries, $40 billion in mortgage-backed securities on net. We think that that's the right place for our asset purchases. Now, we can change them, of course, in a number of different dimensions, should we deem that that's appropriate. But for now, we think that our policy stance on that is appropriate.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. You've spoken about the pandemic's disproportionate toll on Black Americans, Hispanic Americans, Asian Americans, and other groups in the labor market. And I'm curious if you can speak to specific indicators that the Fed will be using to measure job gains for groups that have persistently higher rates of unemployment compared to white Americans. And relatedly, since you've described vaccines as key to the economic recovery, is the Fed concerned about lower vaccination rates in communities of color, and what barriers do you think exist there? Thanks very much.
So which measures? So we do monitor and communicate very regularly about different labor market disparities in the labor market, let's say. So the African American unemployment rate is substantially elevated, and so is the Hispanic unemployment rate. So we look at those and we see those as, it's slack in the labor market. It's sad to see because those disparities had really come down to record lows since we started keeping the data that way. As recently as a year ago, February of last year, we had those disparities quite low. What happens in a downturn, though, is they move up at twice the speed of white unemployment. So we monitor those things. Our tools, of course, affect unemployment generally, but we're going to look at those as a form of slack in the labor market and hope that that there's progress there. And this particular downturn, of course, was just a direct hit on a part of the economy that employs many minorities and lower paid workers. The public-facing workers in the service industries, in many cases, don't have a lot of financial assets. They're not tremendously well paid. They might have other jobs and things like that. So this was a direct hit on that part of the economy, and it's the slowest part of the economy to recover. So, we like to see those people continue to get supported, as the broader economy recovers, which is very much doing now. In terms of disparate levels of vaccination, those are facts, unfortunate facts. They're really not something we have within our policy toolkit to address, but it is true, though, that the data we have suggests that there are significant disparities between different ethnic groups, and but that's not for us. That's for fiscal authorities and the government more generally to work on.
Thank you. Gina Smialek.
Hey, Chair Powell. Thanks for taking our questions. I was wondering if you could talk a little bit about how you see the fiscal policy support that has come down the line affecting the economy's potential in the longer term, just in the sense that you've talked a lot about the potential for labor market scarring and how that might weigh on our sort of future prospects. And I wonder whether you see that sort of working in reverse. If we pull people back into the labor market more quickly, does that improve our chances?
So I do think that fiscal policy overall will have really helped us to avoid much of the scarring that we were very, very concerned about at the beginning. And I think that's just the size and the speed with which Congress has delivered, with the CARES Act and since then, is going to wind up very much accelerating the return to full employment. It's going to make a huge difference in people's lives, and it has already. As I mentioned in my opening remarks, the recovery has been faster than we expected. Part of that just is very hard to predict, given we've never seen an event like this. But part of it is just the strength of the fiscal response, which I think will look good over the years. Longer term, to really, the first part of it is about avoiding scarring, and I think we've not avoided all of the scarring, but we've probably avoided the worst cases there. And I hope we keep at it, and we will keep at it with our policies, of course, to do whatever we can to make sure that continues. Longer term, though, what it takes to drive productive capacity per capita or per hour worked to raise living standards over time is investment in people's skills and aptitudes, investment in plant and equipment, investment in software. It takes a lot of investment to support a more productive economy and raise living standards, and that hasn't been the principal focus with these measures. Our measures, certainly, and we don't have those tools, but what Congress has been doing has mainly been replacing lost income and beginning to, support people as the economy returns to normal. But there should be a longer-term focus, I think, would be healthy on the investment front.
Thank you. James Politi.
Thank you, Chair Powell. I wanted to ask a question about the Eurozone. While the outlook for the U.S. economy has much improved, progress in the Eurozone has been far less encouraging, and it's showing signs of serious weakness due to the slower vaccination rollout and renewed lockdowns and restrictions. How worried are you about transatlantic economic divergence and the possibility that that trouble in the Eurozone and weakness in the Eurozone could drag down the U.S. recovery as it did in a way in the aftermath of the financial crisis?
You're right. The pace of the recovery is, we're having diverging recoveries here, as we did after the last crisis. And in this case, as well as the other one, the U.S.'s recovery is leading the global recovery. And, you know, we conduct policy, of course, here. Our focus is on our objectives are domestic ones. It's maximum employment or price stability here in the United States. We monitor developments abroad, and we know that because we know that those can affect our outcomes. So I think U.S. demand, very strong U.S. Demand, if as the economy improves, is going to support global activity as well over time. That'll be through imports, and when the U.S. economy is strong, that strength tends to support global activity as well. So that's one thing. I don't worry in the near term. I'd love to see Europe growing faster. I'd love to see the vaccine rollout going more smoothly. But I don't worry too much about us in the near term because we're on a very good track. Very strong fiscal support coming. Now vaccination going quickly, and cases coming down. I think we're in a good place. It's all ahead of us, but the data should get stronger fairly quickly here and remain strong for some time here.
Thank you. Hannah Lang.
Hi, thanks so much for taking our questions. I wanted to ask if the Fed is planning on extending the same restrictions on bank dividends and share repurchases that are currently in place into the second quarter, and if you're considering at all the scenario analysis and mid-cycle stress tests that were in place last year, this year, and kind of what would make you consider doing something like that again.
So we haven't made a decision on that. We're a couple weeks away from announcing that decision. I won't foreshadow it here today. I will say we're going to continue our data-driven approach. You know that we restricted buybacks and dividends, so the firms are preserving capital. Through 2020, the banks actually increased their level of capital and their level of reserves. And the December stress tests showed that banks are strong and well capitalized under our hypothetical recessions that we used in December, which were quite stringent. We're right in the middle of our 2021 stress test, and we'll release those results before the end of June. And that layers, very significant additional stress on top of the stress the banks have already absorbed over the past year, with the unemployment rate going to 11% and stock prices falling more than 50%. So. But all of that, the results of the stress test and the decision on distributions, all of that is to come fairly soon, as I mentioned.
Thank you. Edward Lawrence.
Thanks, Chair Powell, for taking these questions. You laid out the standards to lift off, and back in June of 2020, you said you're not even thinking about raising rates. But I see 7 members seeing liftoff in 2023 and 4 next year. How much debate and how can you characterize that conversation has there been about moving off the lower bound earlier than signaled?
Well, it all depends. We've set out very clear criteria for liftoff. Right, where we've said we want to see labor market conditions that are consistent with our estimates of maximum employment. And that doesn't just mean unemployment, it means a much broader set of criteria. We want inflation at 2% and not on a transitory basis, and we want inflation on track to run moderately above 2% for some. Those are the 3 conditions. Everybody on the committee agrees to that, right? So it comes down to what's your projection for the economy. If you want to, people will have a range of assessments for how good the economy is going to be. And, we don't, I would say that we're in a relatively highly uncertain situation. If you look at the uncertainty People on the committee broadly say that uncertainty about the forecast is very high compared to the normal level. We haven't come out of a pandemic before. We haven't had this kind of fiscal support before, totaling it all up. So you're going to have different perspectives from committee participants about how fast growth will be, how fast the labor market will heal, how fast inflation will move up, and those things are going to dictate where people write down an estimate of liftoff. Of course, this isn't a decision to lift off now. We make that decision then, but it's an estimate based on assumptions about growth, and it's meant to be a tool to generally show the public how our objective function works, how we think about the future. It isn't meant to actually pin down a time when we might or might not lift off. We're not going to make that decision for some time. The chances are that the economy in that time and place will be very different from the one we think it'll be. So I sometimes with the dots, I have to be sure to point out that they're not a committee forecast. You know this, but they're not a committee forecast. It's just compiling these projections, really, of individual people. We think it serves a useful purpose. It's not meant to actually be a promise or even a prediction of when the committee will act. That will be very much dependent on economic outcomes, which are highly uncertain.
Thank you. We'll go to Brian Chung.
Hi there, Chairman Powell. I wanted to elaborate a little bit on your commentary about the fiscal stimulus. So it sounds like you, I guess, see the case for even maybe more investment, at least from Congress, to support the more productive economy, as you answered to Gina's question. So we just had $1.9 trillion in spending. So where do you see the fiscal space right now? Do you still, I guess, maybe see the country in a place right now where it wouldn't be a concern if there were to be more spending at this time?
No, so Brian, it's not up to us to decide what Congress should spend money on or when. I was answering Gina's question, which really was, how do we assure lack of damage to scarring, for example, or lack of damage to the productive capacity of the economy? And I think what's happened so far has done a pretty good job of that. But really, I wanted to make the longer run point that if to work on the productivity over longer periods, that comes down to a number of things, but one of those things is investment in people, in their skills, education, aptitude, all of those things. I'm not in any way suggesting that that's something Congress should work on right now, or that that's just not that's not our job. I'm just saying that is what fiscal policy can do. That really monetary policy can't do is invest in the future productive capacity of the economy, raise potential growth. Those things are completely tools that Congress has. And again, I wasn't making a comment at all on the current fiscal setting.
Thank you. Next to Michael Derby.
Great, thank you for taking my question. I just wanted to get an updated view on your sense of your view on financial stability risks and whether or not you see any pockets of excess out in financial markets that concern you, either specifically to that area of the market or as in terms of like the threat that it could propose to the overall economy.
Sure. So, as you know, financial stability for us is a framework. It's not one thing. It's not a particular market or a particular asset or anything like that. It's a framework that we have. We report on it semi-annually. The board gets a report on it quarterly, and we monitor every day. And it has 4 pillars, and those are 4 key vulnerabilities: asset valuations, debt owed by businesses and households, funding risk, and leverage among financial institutions. Those 4 things, and I'll just quickly touch on them. So if you look at asset valuations, you can say that by some measures, some asset valuations are elevated compared to history. I think that's clear. In terms of households and businesses, households entered the crisis in very good shape by historical standards. Leverage in the household sector had been just kind of gradually moving down and down and down since the financial crisis. Now there was some negative effects on that. People lost their jobs and that sort of thing, but they've also gotten a lot of support now. So the damage hasn't been as bad as we thought. Businesses, by the same token, had a high debt load coming in, and many saw their revenues decline. But they've done so much financing, and there's a lot of cash on their balance sheets. So Nothing in those two sectors really jumps out as really troubling. Short-term, I mentioned funding risk as the last one. So we saw again in this crisis breakdowns in parts of the short-term funding markets. Came under a tremendous amount of stress, and they've been quiet since the spring. And we shut down our facilities and all that. But we don't feel like we can let the moment pass without just saying again that some aspects of the short-term funding markets and more broadly non-bank financial intermediation didn't hold up so well under great stress, under tremendous stress, and we need to go back and look at that. So a very high priority for us as regulators and supervisors is going to be to go back, and this will involve all the other regulatory agencies. It does involve all of them as well, and see if we can strengthen those things. So that's a sort of a broader, detailed look.
Thank you. Michael McKee.
Mr. Chairman, can you help me understand something about the SEP and your forecasts? The inflation that you're talking about for this year, say, is transitory. Then by 2023, you're back down to 2.1%. There's no forecast for a rate increase for 2023. If you get to 3.5% unemployment, but inflation's only at 2 or 2.1%, are you willing to leave rates at zero going forward from there, or roughly zero going forward from there? In other words, could we be in a Japan-like situation where rates just stay low because inflation does?
Well, again, I wouldn't read too much into the March 2021 SEP dot plot. Remember what it is. It's a compilation of individual projections by individual members. They're all making different assessments. They have different forecasts, economic forecasts. Some have more optimistic ones, some less optimistic. And also remember that the SEP doesn't actually include all the things that go into maximum employment, right? It only includes unemployment. So I would just say we've set out clear guidance. The message from the SEP that I would like to leave with people is we set out clear guidance. I mentioned what it was. It's inflation it's labor market conditions consistent with our estimates of maximum employment, and that's not just unemployment, it's all the other indicators, but overall totaling up to maximum employment. It's inflation at 2% and not on a transient basis, and inflation on track to exceed 2% for moderately for some time. Those are the criteria. We're committed to robustly implementing that guidance, and that's what this says. That's really all it says. We're going to wait until those requirements are met. And again, the state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future.
If I could follow up, I'm just wondering, before 2019, shall we say, you were focused on the problems with having interest rates too low. Now, are you saying we're willing to live with it until we reach these goals, even if you reach your goal on maximum employment?
So what I would say is we're committed to giving the economy the support that it needs to return as quickly as possible to a state of maximum employment and price stability. And, to the extent having rates low and support for monetary policy broadly, to the extent that raises other questions, we think it's absolutely essential to maintain the strength and stability of the broader financial system, and to carefully monitor financial stability questions, if that's what you're getting at. We do that. We monitor them very carefully. I would point out that over the long expansion, longest in U.S. history, 10 years and 8 months, rates were very low they were at zero for 7 years, and then never got above 2.4% roughly. During that, we didn't see actually excess buildup of debt. We didn't see asset prices form into bubbles that would threaten the progress of the economy. We didn't see we didn't see a housing bubble. The things that have tended to really hurt an economy and have in recent history hurt the U.S. We didn't see them build up despite very low rates. Part of that just is that you're in a low rate environment. You're in a much lower rate environment, and the connection between low rates and the kind of financial instability issues is just not as tight as people think it is. That's not to say we ignore it. We don't ignore it. We watch it very carefully, and we think there is a connection. I would say there is, but it's not quite so clear. We actually monitor financial conditions very, very broadly and carefully, and we didn't do that before the global financial crisis 12 years ago. Now we do, and we've also, put a lot of time and effort into strengthening the large financial institutions that form the core of our financial system are much stronger, much more resilient. That's true of the banks. I think it's true of the CCPs. We want it to be true of other non-bank financial intermediation markets and institutions. So I think that's monetary policy should be, to me, provide for achieving our macroeconomic aims. Financial regulatory policy and supervision should be for strengthening the financial system so that it is strong and robust and can withstand the kinds of things that it couldn't, frankly. And we learned that in 2008, 9, 10. This time around, the regulated part of the financial system held up very well. We found some other areas that need strengthening, and that's what we're working on now.
Thank you. Anakin, CNN.
Thanks for taking my question. Jerome Powell, could you talk to us a little bit about the relationship between the persistent pandemic unemployment and the expected increase in inflation? Does the former offset the latter to some degree?
I'm sorry, could you repeat that? You broke up there for a second.
Oh, no. I was hoping that wouldn't happen. Can you hear me now?
Yes, yeah.
Okay, great. I was asking if you could talk to us a little bit about the relationship between the persistent pandemic unemployment and the expected increase in inflation. I'm wondering whether the former offsets the latter and to which degree you guys are monitoring this.
You're asking about the relationship between unemployment and inflation? Is that the question?
Yes, exactly.
Okay.
They offset each other, the persistent pandemic unemployment.
Yeah, I think I'm hearing you correctly. So I would say a couple things. There was a time when there was a tight connection between unemployment and inflation. That time is long gone. We had extremely low unemployment not extremely low. We had low unemployment in 2018 and 19 and the beginning of 20 without having troubling inflation at all. We were at 3.5%. We were bouncing around with unemployment 3.5% to 4%. And it wasn't just unemployment. Participation was high. Wages were moving up. It was a very healthy thing. And we didn't see price inflation move up. There is a relationship between wage inflation and unemployment. But that has not – what happens is that when wages move up because unemployment is low, companies have been absorbing that increase into their margins rather than raising prices. And that seems to be a feature of late cycle behavior. So we're not when we seek to achieve low unemployment, high levels of employment, which is our mandate. We think we have the freedom to do that based on the data, without worrying too much about inflation.
Thank you. Going to Greg Robb.
Hi, thanks for taking my question. I wanted to follow up a little bit. I understand what you're saying about the dot plot and the message you're trying to send with the dot plot, but does the same apply for the taper tantrum? You've said that it's going to take some time to get some fundamental progress on your goals, but it seems like some time could now be any time.
Well, so we've said substantial further progress. Now, if you go back November, December, and January, progress in the labor market slowed very sharply. So you had an average of 29,000 jobs per month. If you go back and look at the level of job creation before that was very, very high, very high. So we weren't making any progress on the labor market from November through January. February, we saw a nice pickup, a good jobs report, 379,465 private sector. So that's good. It can go so much higher, though, and it would be nice to see to really make faster progress. That's different from substantial progress. We'd like to see it be higher than that, and I think it will be. That's the expectation. Is you'll see now, I think, really strong job creation return. Not as high as it was in the very early days of the recovery, the reopening of the economy, but nonetheless very strong. Okay, so what I'm saying is, to achieve substantial progress from where we are, having had 3 months of very little progress, substantial progress from where we are, having had 3 months of very little progress, it's going to take some time. And we don't want to get into, I don't want to get into trying to put a pin on the calendar someplace, because it's going to be data dependent. When we see ourselves on track to make substantial further progress, we're going to say so. We understand fully that test is one that involves judgment. If you remember, during the global financial crisis recovery, we said quantitative easing number 3 was the test was a substantial improvement in the outlook for the labor market. Well, what does that mean? Well, it means a substantial improvement in the outlook for the labor market. It meant we would communicate when we thought we had that. This is just like that, in a way. What we're saying is substantial further progress toward our goals. We'll tell people when we think, until we give us a signal, you can assume we're not there yet. And as we approach it, well in advance, we will give a signal that yes, we're on a path to possibly achieve that, to consider tapering. So that's how we're planning to handle it. It's not different really from QE3. And I think what we've learned from the experience of these last dozen years is to communicate very carefully, very clearly, well in advance, and then follow through with your communications. In this case, it's an outcome-based set of guidance, as our rate guidance is, and it's going to depend on the progress of the economy. That's why it's not appropriate to start pointing at dates yet.
Thank you.
Thank you. Don Lee, LA Times.
Hi, Chair Powell. As you know, households are sitting on a lot of excess savings, and I wonder if, combined with that, you have an unleashing of pent-up demand. How much do you think that would affect inflation, and would you expect that to be transitory?
And everyone who's forecasting these, what we're all doing is we are looking at the amount of savings. We're looking at, we have reasonably good data on that, and we're looking at the government transfers that'll be made as part of the various laws, and we're trying to make an assessment on what will be the tendency of people to spend that money, the marginal propensity to consume. And from that, you can develop an estimate of the impact on spending, on growth, on hiring, and ultimately on inflation. So that's what we're all doing. And we have, we can look at history and we can make estimates, and those are all very transparent and public, and you can compare one to the other. And of course, we've all done that. And I think we've made very conservative assumptions and sensible mainstream assumptions at each step of that process. And what it comes down to is what I said before, which is there very likely will be a step up in inflation as March and April of last year drop out of the 12-month window because they were very low inflation numbers. That'll be a fairly significant pop in inflation. It'll wear off quickly, though, because just the way the numbers are calculated. Past that, as the economy reopens, people will start spending more, and that you can only go out to dinner once per night, but a lot of people can go out to dinner, and so and they're not doing that now. They're not going to restaurants, not going to theaters. That part of the economy and travel and hotels, that part of the economy is really not functioning at full capacity. But as that happens, people can start to spend. It's also wouldn't be surprising if, and you're seeing this now, particularly in the goods economy, there'll be bottlenecks. They won't be able to service all of the demand, maybe for a period. So those things could lead to, and we've modeled that. Other people have too. And what we see is relatively modest increases in inflation. So, but those are not permanent things. What'll happen is the supply side. The supply side in the United States is very dynamic. People start businesses. They reopen restaurants. The airlines will be flying again. All of those things will happen. And so it'll turn out to be a one-time sort of bulge in prices, but it won't change inflation going forward because inflation expectations are strongly anchored around 2%. We know that inflation dynamics do evolve over time. There was a time when inflation went up, it would stay up, and that time is not now. That hasn't been the case for some decades. And we think we won't suddenly change to another regime. These things tend to change over time, and they tend to change when the central bank doesn't understand that having inflation expectations anchored at 2% is the key to it all. Having them anchored at 2% is what gives us the ability to push hard when the economy is really weak. If we saw inflation expectations moving materially above 2%, of course, we would conduct policy in a way that would make sure that didn't happen. We're committed to having inflation expectations anchored at 2%, not materially above or below 2%. So that's, I think if you look at the savings, look at all of that, model it, that's kind of what comes out of our assessment. There are different possibilities. I think it's a relatively unusual, very unusual situation to have all these savings and this amount of fiscal support and monetary policy support. Nonetheless, that is our most likely case. And as the data come in and the economy performs, we'll of course adjust. Our outcome-based guidance will immediately adapt, we think, to meet whatever the actual path of the economy is.
Thank you. We'll go to Scott Horsley for the last question.
Thanks, Chairman Powell. My question is about those supply chain bottlenecks, especially on the goods side. Are they getting better or are they getting worse? We saw they were sort of a drag on the industrial production numbers that came out yesterday. And what do you expect them to do to prices just in the short run?
I think it's impossible to say, frankly, with any confidence, but I would expect, it's very possible, let's put it that way, that you will see bottlenecks emerge and then clear over time, and you'll probably see that over a period of time because, really the strong data are ahead of us. You're right now that the checks are going out just now, and that'll add to spending. COVID cases are coming down. Vaccination is moving now quickly. The really strong economic data is coming. It should be coming, assuming we stay on this track. And that's when you'll really know where the bottlenecks are. But you can see, though, that these are not permanent. It's not like the supply side will be unable to adapt to these things. The market will clear. It just may take some time. And some of the answer to that may be price. In many cases, it won't be price. You'll see that people are reluctant to raise prices. It's a little bit the story about, the wage Phillips curve does show that as unemployment goes down, wages move up. But companies choose not to try to pass that price increase along to their customers. So you'll see a lot of that here too, I think. Anyway, we'll see. But that's my basic sense. Thank you very much.
Thank you.
Dover, finally we could talk about some stonks, guys. We've been seeing Gme pullback and AMC still pretty much at 1330, guys. We are seeing power hour here. We have 30 minutes left. Like always, power hour usually comes really late or really early. And in this case, it's coming 30 minutes late. Let's see if we can have a reversal on GameStop. Let's see, 210. Someone asked what the next level of support is for GameStop. The thing is, guys, even if we close here above 210, we still have the higher lows forming. That's always going to be a key for GameStop. Look at this. It's riding the 4 hour beautifully. I'm not too worried on GameStop, honestly, either on AMC. Both are uptrending. My target for this week is still 18 bucks on AMC. Oh, yes. If you guys are not aware, there's a fake account out there asking for Bitcoin or a WhatsApp, just using my name. So thank you, TJ, for reminding me. And in tonight's video, that account might still be spamming. So it's it'll have a highlight on the name if it's my account. If not, then it's somebody else, wherever it is. The name will be highlighted. I wonder if the congressional hearing for GameStop is still going. Let's see. No, it ended an hour ago. Oh yes, by Neo, by Tesla. Tesla, guys, I think was ripping. Oh my gosh, talk about FOMO, man. How did futures? I think futures ripped like crazy. Yep, futures did rip. Apple, right? Look at Apple, man. From 122 to 125. Amazon, Netflix, Facebook, SPY as well. New highs on SPY. You kidding me? Oh my gosh, stocks only go up, man. Very interesting that GameStop pulled back while Nasdaq shot up. I'm telling you, I feel like they're inverse ETFs right here going on. What you're seeing on GameStop. Yeah, Tesla went crazy. You guys kept putting it in the chat, and I was just wanted to look at Tesla. I was looking at the price here on Google. How's Neo? It's probably ripping like crazy too. 44 down from 41 on the low of the day. End of week for AMC is 18 bucks. For GameStop, end of week. I want to close above 250 for the end of the week for GameStop, guys. Remember, we have earnings next Wednesday. Wednesday, right? The 25th? Is that Wednesday or Thursday? Thursday on the 25th for GameStop. $14 million volume for GameStop today? Yeah, Tesla. One of the Teslas crashed into a police vehicle, a state trooper vehicle. The stock did not care. Yeah, AMC held today. I'm pretty surprised it held and did not follow GameStop on the way down, honestly. Let's see. Double bottom here, 208. It's not looking too bullish, guys. Yeah, I'd rather have a slow day for AMC than a free fall. Absolutely. We're still continuing that pattern if you look back here at the 15-minute. Or let's zoom back a little bit more. When in doubt, you guys know, zoom out. Uptrend pulls back, consolidates. Uptrend pulls back, consolidates. Uptrend, and we're at the pullback right now. We're consolidating before another push up. That's why I still think we could hit 18 bucks. Any short available updates? I don't even want to take Fintel anymore. I don't trust Fintel. Freaking Bitcoin. Give me 1 second. What's up, Gilbert? Welcome back. You guys want me to check Fintel or no? Check it or no? I think GameStop earnings are on the 23rd. Speaking of GameStop's earnings, the conference call on March 23rd, 5 p.m. is a must listen. The 23rd, really? Let me check. I might be wrong. Oh, you're right. Did they change them? They did change them, right? I could have sworn they were on the 25th. This happened on AMC twice. Twice. AMC earnings were on February 25th, Thursday. They changed them to March 2nd. and then they finally changed them to March 10. Or either that or I'm losing my mind. I could have sworn they were on the 25th. It's been the 23rd? I guess I'm going crazy, guys. I'm going crazy. Jen, it's not that I don't trust you, it's that I could have sworn they were on the 25th. Check Fintel, yes, yes. Ryan Cohen tweeted. Oh my god, he tweeted. Oh my god. He tweeted, Superman lives forever. Is this his dad? Or what? Someone said, is he your father? I thought it looks like I think it's his dad. I love my dad. Ralph is stoned? No, I'm not. Dad pump. I trust Cohen, man. I can't wait for next week. Next week literally will be make or break for a lot of people on games. I'm being honest. Next week is going to be a big deciding factor for a lot of people. No, no, I'm not giggles. Um, Not a lot going on now. We're waiting for Tom Brady. TV12 to come in through right now in a couple minutes. We're still waiting. All right, let me check Pinto. You guys got me curious, man. Pinto always lags when I open it. There's always a delay. All right, let's see it together. Take a look at this, guys. For GameStop 2 minutes ago, there's 550K short shares there's available 550K. The fee is less than 1%. I call massive BS on that. AMC, let's take a look together. An hour ago, 4.7 mil with the fee of 1.31 BS. AMC slowly creeping here. Tom Brady vibes. I'm getting them. March 19 and the earnings will be a catalyst for GameStop to skyrocket. I think the biggest, it's not even March 19, the quadruple witching, which haven't talked about because I don't want to put dates on things. One of the easiest way to get disappointed and to get spooked out is to get your hopes up. So I don't want to get my hopes up, but earnings, I'm gonna get my hopes up on that. I'm taking my bet on that, on earnings, not the quad witching. If something happens that day, oh well, it does happen. Better for us, we benefit from it. But if nothing happens, then I'm not disappointed. All right, I like the spike. Looks like Tom Brady is coming through. GameStop still double bottom. This happened the other day, guys. It had the H pattern, the descending triangle, and then it went to new lows. So I would not be surprised to see GameStop at $200 in the next couple minutes. I'm gonna set my alert just in case. I won't be surprised. Zoom in on AMC. You guys like when I zoom in, right? You guys like when I like literally zoom in like this. You guys want to see candles like this, huh? That's pretty good right there. Just one color. Vinto bought some AMC. All right, there's that double bottom here, guys, at 207. It might sell off right now. Let's see. It's not looking too strong. He hasn't tweeted. He tweeted earlier though. My smooth brain can only handle 3 candles at a time. Well, all this is just history. What's really happening is right there at this 1 minute candle. All right, we're at the final fourth quarter, guys. Fourth quarter, last 15 minutes. I'm not colorblind. What were you laughing at? Powell's haircut is similar to yours. Um, I thought the tax deadline was pushed. I don't think it might. I think it was. Every day, Jennifer says every day I wake up to attend Ralph's stock classes. Sold account. I appreciate you. Welcome. Subscribe. Welcome to the channel. Welcome to the community. It's not pulling back as aggressively, guys, as I thought. Honestly, it's not pulling back as aggressive. Very interesting. Did Kramer call you today? He usually calls me around this time. Ralph Trey said Fintel bought 557,000 of AMC. Where can I find that out? We're gonna see that. Let's see. Marketbeat.com. Let's check. They don't even believe their own numbers. Let's see. AMC. Hmm. Oh, the giveaway. I forgot. I forgot about that. Sorry about that. App. All right, let's do it. Giveaway time. AMC 1338. Honestly, I'll be happy if we close not at a whole number, not fighting the 1 cent mark, not fighting 801, not fighting 1301. Let's close at least mid 13s. Rigged, rigged, rigged. Watch out. How many times do you guys want me to shuffle it so you guys won't say it's rigged? All right, here we go. Just like and comment on the video, and you guys are automatically entered. We'll give it 5 minutes. Give his cousin some love. You guys are hilarious. Did I pin this? Let me see. 420 times. One time. 69 times. How do I play? Just like and comment on the pin video so you're automatically entered. We used to do the giveaways on Twitter, but a lot of you guys don't have Twitter, so it's just easier to comment because you guys have a YouTube account, right? Oh my gosh. Here it comes. Here comes AMC. It's slowly creeping, guys. AMC's like a little, it's a slow stepper. 1349. I'd love to see 1350. Ralph is a big stoner. 801 times. Twitter sucks. Guys, guys, thank you guys so much again, once again, for 14,000 subscribers. I don't know how that's possible. I don't know how that happened, but we hit 14.2K subs. PS5 giveaway, not rigged, at 15K subs. PS5 giveaway. Spacesuit giveaway at 20K subs. We're giving away the spacesuit. I'm just playing. I'll probably never give this one away. Just give it 5 minutes because the comments are still coming in here. We'll give it some time. Where's your silver play button? I think that comes in when you hit 100K subs, right? Or is that? Come on, AMC. Hey, guys, big W's if we close above 1350. Right here. This is what we want to close at. 1350. GameStop is holding here. I literally thought it would not hold. I'm happy. For GameStop, we want to push to like 211, 212. I'll be happy with that type of close. I appreciate that, Frank. The best stream. I appreciate that. PS5 is not rigged. His niece is getting it. Greg, can I become a mod? If we get 420 likes in the next 10 minutes, we'll do another giveaway today on Twitter this time. Just for my Twitter folks. I know there's some of you guys mentioning you guys want it on Twitter. If we get a 420, you're giving me Big Daddy vibes. You know what? You know what's also interesting that I'm probably gonna willing to do? You know, some of you guys have notifications on for this channel, and you guys always comment first, right? You know, you click the video, you comment first. Let's do that as well. The first person who comments on any video wins another gift card. So I guess we're giving away 2 gift cards every day. Moneybag vibes. I like Moneybag a lot. He's a client of mine, by the way. Moneybag. Moneybag yo. Needs to shave his head. I will shave my head if AMC hits 50 bucks by the end of the month. First person to put inflation in the comments gets a gift card. Rip hair. I'm gonna be twinning it with Jim Cramer. How do I comment on the pinned video? You click the video and you comment on it. I don't, is it difficult? Is it not showing the video or? Yes! Yes, we're pushing AMC. This is what I'm talking about. Come on, come on. We're close. We're close. Give me 1350. Give us 1350. And GameStop, give me 212. Give us 212. Kramer is right behind me. Yeah, right. Jamer. Um, let's see. Let's see. The comments are still coming in, guys. So let's wait. All right, let's see. GameStop is still pretty much flat here at 207. Let's have a massive push to 211. Let's close above 1350 for AMC. We're still waiting. Comments are still coming in. I want to get some coffee. No, I haven't done the giveaway yet. I'm still waiting because the comments are coming in. GameStop, what are you doing, bro? No, it's not the right way. You're going the wrong way. I hate the whole numbers, especially on the way down. There's stop loss hunting right there. Stop loss hunting. Inflation is a meme. Every 10 cents is a wall. I disagree. I believe every 5 cents there's a wall. But don't test 200. I'm not surprised, but I'm not impressed. 7 minutes. Come on, AMC. Come on. Come on, baby. Come on, baby. It's right there. It's literally opposite of GameStop. Really surprised. GameStop does not have PS5s. Come on. It's coming. It's coming. You guys think we hit 1350? Is 1350 a meme, guys? Is 1350 for AMC a meme? Come on, baby. We got 6 minutes. Actually, we got 5 minutes. A lot can happen in 5 minutes. Take a look at the clock up here on the left. Can you guys see this? It's gonna go red. There we go. 5 minutes. It's not a meme? No. Play the Kramer video for the last minute. That's our sign-off video. The Kramer video. 47! Come on. Is 1350 a meme? Say it with me. A new high is not a meme. Say it with me. 48. A new high is not a meme. Turn your monitors upside down. Come on. Come on. Yes! 1350. A new high is not a meme. I can't believe we did it. Look at that huge wall there. Guys, look at the ask on AMC at 1350. Damn it, these sellers. Can it break out? Will we see 1350 plus on AMC, guys? Do you think the strength is there? Look at this. It wants to pop. Tom Brady came through today, guys. Oh, we're getting rejected. You guys think we break out? Oh. There's still time. There's still time on the clock. 4 minutes. Rob Jr.? You talking about Mr. Jamer here? That's a nice cup and handle. Absolutely. Come on, you there? Oh my gosh. Are we going to break above 1350? Oh, it's coming. It needs a little stroking. It needs a little help. Go, go, come on. Let me see that order flow. Oh, it's coming. 1640. Oh, we got time. We got time. Talk about a wall, man. Oh my God. Oh my God, we're breaking it. Yes! Let's go, baby. That's all I need sometimes, man. A little stroking. Is a new high a meme? Can we see 1366 in 2 minutes? Can we go parabolic right now? The GameStop is dead right now. What's going on? Powell pump. Oh my gosh, GameStop's alive. GameStop's alive, 206. Let's shoot up to 210. 210. Let's lower the alert here. We got literally 2 minutes. Oh my gosh, 1354. We got the highs here at 1366. Is it a meme, guys? Answer me. Is it a meme? Is 1366, 10 cents above, in 2 minutes a meme? I guess we'll find out right now. Oh, I'm gonna have a heart attack. My palms are getting sweaty. Look at GameStop 210. Come on. Manifest it with my smooth brain. TB12. The show goes on. You guys are saying it's not a meme? It's not a meme. We got this. Oh my gosh, we have a minute and 30 seconds. My palms are sweaty. Oh. Oh, GameStop 207. Please don't sell off. Please don't sell off. GameStop's coming. 207. My brain's so smooth it slid out when it hit buy. You stroke these candles like nobody else can. Let's see it. Come on. That's all it needs. 5 cents. 5 cents in 50 seconds. A cent every 10 seconds. That's literally what we need. Every 10 seconds, we need to move 1 penny. Go. 56. Stop struggling. GameStop is literally going to our price target, guys. 210. We are seeing the push we wanted to. Is that going to help AMC? It's not ticking. Come on, guys. We got 30 seconds. Go, go, go. Come on. We got it. We got it. I can feel it. 57. 58. Come on. Oh. GameStop's about to break out. GameStop is doing it. 209. My palms are sweaty. $209.96. Guys, we closed above 1350. That's go! W's in the chat. Let me just see a million W's, man. Oh my gosh, I can't believe we did this. Oh, we closed green on both songs. Oh my gosh. That's all it needs, man. These candles, all they need is a little stroking sometimes. What a day, man. So I'm gonna get a heart attack one day on one of these live streams. Oh, man, it's such a roller coaster today. We had Daddy Powell at the congressional hearing. Earnings is next week. It's gonna get exciting. Literally, as I look at the clock, it's 4:20. We hit 420 on the likes. 420 likes, GG. All right, let's do that giveaway. Let's do that giveaway, baby. Giveaway time, yes. It's time to give away. Oh, I forgot. The after hours orders. There's always some crazy block of orders. 2 blocks of 4 million? What the? Who did this, guys? Why is there 2 blocks of 4 million on AMC at 1356? There's no way. I want to buy some more AMC. That's freaking epic. Just shat myself. Guys, there's 2 blocks of 4.7 million. How can I screenshot? How do you screenshot on a Windows computer? That's the question of the day right there. How do you screenshot on a Windows? That was me. Whoa, 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 slow down, guys, slow down. Wait, snippet, what is that? You guys are, oh my gosh, you guys are crazy. Shift PRT. Guys, I'm a smooth brain ape. You guys, snipping tool. Check my keyboard. I need to save this before it disappears. Okay, I'll make it easier. Someone screenshot this live stream. Can you guys see the number clear? And just tweet it at me or something. Send it to me. Because my smooth brain ape is gonna forget it. Send it to you on Twitter. Oh, perfect. See, you guys are one step ahead. You read my mind there. Let's see. Perfect. Thank you so much. I'm using my phone as my camera for those of you that did not know. I am an idiot. I'm a boomer. Oh, I deleted it. Let me see. Give me one. My phone is my camera, guys. Um, Perfect. You guys are amazing. You guys are amazing. All right, there we go. We saved that. Look at this. Isn't this just beautiful? 2 blocks of a milli. Any other crazy ones? You could sort these orders. How about game stonk size? No. Who won the PS5? We haven't gave away the PS5 yet. PS5 is at 15K subs. But let's do that giveaway right now for you guys. What's your Twitter? We've been seeing that consistently, guys, by the way. There's been huge chunks of orders of like 300,000. There'll be a day where it'll close and there would be 300K orders. That's why we took a look right now and we just saw 4.7 million. All right, my Twitter, let me see. Let me add Jim Cramer. Let's see if he blocks me. Give me that badge of honor. I'm gonna put add Jim Cramer. Hey, hey with 3 Ys. I try to get him on here. That is my tweetal. Crazy, crazy. All right, let's do the giveaway. And you guys said you wanted me to shuffle it 5 times, right? So you guys want to know it's rigged? Or 3 times? Alrighty. Let's pin this. Oh my gosh, 1360 after hours. Guys, are we gonna break 67? You guys think we could break 67 after hours? So rigged 3 times? 3 times with the 3 times with the 3 second countdown. All right, I'll do that. I'll do that. It's not working. Oh, there we go. Oh my God, I scared myself with that. Okay. Here we go. 64 after hours. I'm gonna poop myself. I'm telling you, one day I'm just gonna have a stroke on camera. These stocks are gonna drive me insane. All right, here we go. Arby's Arby's gift card? Are you kidding me? We support our favorite stonks, man. We got like a ton of AMC cards. I forgot where they went. But for those of you who have won here, it's not rigged. Someone verify, vouch for me. Come on, guys. WPF free shares. You get free shares if you sign up with Webull using the first link down below. You and me both get free shares, and I'm pretty sure we both get WPF. WPF shares. All right, let's go. 68 after hours. Oh my gosh, guys. How do we enter the giveaway? You just comment on the previous video. Rigged. All right, let's wait 2 more minutes then. For those of you who just joined, 2 more minutes. I'm gonna post a video link there. Just like the video and comment. You're automatically entered. Let's just wait. Let's wait. Giving you guys a chance. $69 after hours for the memes. AMC. I'm one of the biggest shareholders in WPF, thanks to Webull. So one day, knowing my luck, this stonk WPF is going to go to the moon. One day, I'm gonna wake. I have my alert said, look, one day I'm gonna wake up. It's gonna be at $300. You just gotta trust the process and manifest it. 1370 after hours. All right, the comments are coming in. Let's wait. If you just entered in the last 2 minutes, what are you doing? Guys, 1370 after hours is getting me a little excited. I'm still sticking true to my price target, $18. All of our price targets, I'm not trying to be like cocky or anything here, but all of our price targets on GameStop and AMC, since GameStop was at $48 and since AMC was at $5, have been right. Like, it's just been a crazy ride, and I think I might be wrong sooner or later, and I think this might be the time I'm wrong. I don't know. We have 2 trading days left. We have to hit 18. If not, then I'm still happy, you know. But that's I'm gonna stay true to my price target. I'm not gonna change that. 18 by the end of the week is not a meme. Matt, thank you for the dono. WPF 200 is not a meme. Thank you for all the donos that came in earlier that I wasn't able to read because Daddy Powell was speaking, but you guys don't have to donate. You guys know. Don't donate. Just use that money. Put it in the stock market. All right, let's go. Let's refresh it 2 times just to make sure it's not rigged. Put it in here. All righty. All right, so you guys said 3 times, right, with 5 seconds? 3 times, right, with 5 seconds? Or how many how many refreshes do you guys want? I'll let you guys pick. Are you selling at $18? Honestly, I think if it does hit 18, I might lock in half of the profit. And as soon as it pulls back under EMA, I'm gonna rebuy. So I don't know yet. I don't know yet. 69. I'm not gonna do it. It takes forever to reload. 5 times. All right, I've seen that twice already. 3 times, 3-second count. Let's do that. 1, 2, 3. Settings. 3-second counter. I forgot I can't do the counter because I have to pay for ads. So let's just do 5 seconds. Here comes the rig comments. All right. Good luck to all. Good luck to all. 0 shuffles. All right, here we go. 5, 4, and the winner is ta-da! Damian Williams. Damian is here, I believe. He says grabbing up more AMC tomorrow as well. If you did today, congrats on that because AMC is up 4%. Wait, where's Damien at? How is it rigged? Damien, you're here, right? You were here earlier. Damien, come on, vouch for me. Where is he? Damien was here, man. Oh, you guys are killing me, man. And guys, for those who did not win, someone almost fooled me the other day, right? I'm like, hey, Damien, or in that case, it was Zero Blade. I'm like, DM me on Instagram, and someone else tried to fake it, impersonate Blade Runner. So if you win, just send me a screenshot of your YouTube channel just to make sure, because I almost got fooled yesterday. Someone tried to be sneaky. Where's Damien at? He was here earlier, I think. Damien. Ah. Let me see. Let's look for that comment on YouTube. All right, let's do another giveaway, but for Twitter this time. Tweet all. Let's do Twitter. All right. Literally, guys, someone, my fake profile just commented on my video. Someone here's watching with that fake profile. Watch, I'll show you. These trolls, man. So just if you see that account tonight, just report it, please. Just report it. Comments. We got one more giveaway. Give it like 5 minutes and then we'll end it. Take a look at this, man. Oh yeah, this profile picture does have a bigger head. Take a look at this. Should we like WhatsApp this person on stream live and just see what they want? Look at this. Just report this, guys. They'll reply to you tonight. They'll be back tonight. Do you have a Discord? Yes, it's free. Here you go. Join the Discord, baby. WhatsApp him on live. Should I like? Bill says he'll shave his head if he wins the next gift card. All right, guys. I'm happy with this after hours close. We did break past that resistance. All right, I'm gonna plug in the Discord one more time. All right, let's go. With that being said, let's do this one last giveaway. Good luck to all. Can't do Twitter. It's blocked on my computer at work. All right, let's do it. Let's do it, and then we'll end it. All righty, here we go. Here we go, baby. How do we enter? Check out the pinned link in the chat on YouTube. It should take you to Twitter and just reply to the tweet or something. $13.65. When are you posting your next video? I have to work on that video after this stream, and then I'll have that video out like in 2 to 3 hours. Ralph Highness is not. I am not high yet. What's the worst hedge fund manipulation? What's the worst, the hedge fund manipulation or the Ralph manipulation? All right, let's do it. Fake Ralph. That's gonna become a thing of this channel, the Fake Ralph. Fake Ralph does multiple giveaways only on YouTube. Fake Ralph blazes nonstop and it barely affects him. Ralph works for the hedge funds. Interesting. What if Ralph is Citadel? Yeah, we pretty much did an all day stream, right? That's pretty crazy. All day streams are crazy. All right, let's do it. Let's shuffle it. 2 times, 3 times, 4 times. There we go, 5 times. Mo Vegas 20 with the AMC profile picture. Walker Talker and Sports Watcher. Is he here? Mo Vegas 20. Let me reach out. Mo Vegas 20. What a legend. What a legend. Look at his profile picture. AMC, look at the header. 801. What a legend. That's fake. Wait, what? Fake Ralph has paper hands. Oh, After Hours AMC. 1375. Oh, I love this. Look at the screen. Look at this screen. You read the Wall Street article about Robin Hood getting margin called Louis, thanks for the dono. Send me that article. Send me that article. Also, guys, thank you for those of you guys who are sending me articles to read. You don't know how much that helps. Like it makes everything so much easier. It really does help. Like when you guys tag me on tweets or send me certain links and articles, that truly helps. It really helps. I appreciate all of you guys that do that. That's another reason why I think, guys, it's so interesting to me. I was thinking about it. The first time GameStop fell, and we'll probably end it with this thought, was right around when it got halted, it was like at 320 something, right? Because I remember buying at 320, and literally as I bought, my luck, I got caught in the halt. It was around 320 something. And the second time around Wednesday, what price was it at? Like around the 300s as well. I think after it crosses a certain level, I think some people just blow up. Hedge funds will really go belly up. Like they'll get margin call like crazy. It'll just be crazy. That's my little conspiracy there. I think they're not letting it cross a certain level again. That's why it's so odd to me. So weird. Does anyone else think that? But look at AMC go. Oh my gosh. $18, baby. I'll see you Friday. 87. Whoo-hoo. Matt says every day you should do a 5 to 10 minute little news on DD you find, we find. I think everyone would enjoy it. What do you mean, like sharing the articles like you guys find, like on Wall Street Bets and stuff? Because some people on there have some crazy DD. Yesterday, you guys sent me a price target for GameStop being 10,000 solely off technical analysis, the wave theory, I believe it was called, which is pretty interesting. 92 after hours AMC. Oh my gosh, I'm gonna lose my mind. I knew I should have bought more today, but I bought yesterday. I think even if you got in yesterday, guys, you were still pretty in at a good spot. What was yesterday? 1273. So you could have added more on the dip to the 4 EMA, but still, it still continued the uptrend. Even if we do see a pullback tomorrow, I'm going to be adding more. 95. I think we could hit $14. After this, right now, after hours. Thin volume, however, but we're still moving, guys. What kind of water is that? The Sam's Club water, members mark. What software do I use? This is called Thinkorswim by TD Ameritrade. There's a video in the description below. I'll walk you step by step on how to open up the account, how to download Thinkorswim, how to set it up exactly like this. Get the same look and feel. Check Tesla now. Don't make me get FOMO, man. $6.99. Yeah, those massive orders. Oh my gosh, I can't stop thinking about that. It's vodka. It's vodka in the Costco bottle. Ralph, I wired you BTC. Let me know when it hits your wallet. Bro, that's not the real account. You wired some scammer somewhere out there. I don't know where. 95 again. How do you get that level 2? You just hit level 2 right here, and it brings it up. And you could actually just like drag it up, whatnot. Same thing with the TNS, the times in sales. I love Thinkorswim. Put vodka in a Dairy Queen Misty and thank me later. I don't think I've ever been a Dairy Queen. $95. Yes, $14. I can't believe it. $14, man. Come to Texas, I'll bring you to Dairy Queen. 1404. Oh. Oh my gosh, guys. $500 likes on the video is not a meme. Is it? Can you guys hit 500 likes before we end it? 500 likes. And then we'll end the stream, guys. Stimmy checks are coming in. Who got stimulated today? Who has yet to be stimulated today? You got stimmied. I got mine. I need to be stimulated. No stimmy. Haven't got it. I got stimulated twice. Not in yet. I got stimmied. I am unstimmied. I got it. I got it. I got mines. My wife got stimulated this morning. Says Fred. Guys, you guys blew up the likes. That's crazy. I love you, all of you guys. But I guess we're gonna have to end it here, guys. I'm gonna have to work on a video for you guys. A video. I can't believe we hit $14. That's insane. But yeah, let's do that. Let's start the new. So obviously we have the Power Hour giveaways, but let's add more giveaways. So let's do first comment. First person to comment on every video just wins. Man, this price action is not gonna let me. It's not gonna let me leave. 14.10. What do you mean? Can we start that today? I don't know what you mean. The DTCC rule just passed. Effective March 16. Oh my God. Guys, I'll see you guys later.